Now we will do one problem, finance lease problem from Lessor's perspective. Let's see problem number 2012. J. Burger Corporation manufactures drones. On December 31st, 2024, it leased to Althas Company a drone that had a cost of $120,000, and the lease agreement covers 5 years useful life and requires 5 equal payments. And these payments or the rental installments are given 40,800, and it's payable at the beginning, and the date is December 31st, 2024. Interest rate to discount is also given here, 8%, and the rental collection is probable. So now we have to do the lessor's journal entry. This one is very straightforward. There is no residual value issue, no bargain renewal options or bargain purchase options. So here on the very first day, of course, the lessor will record it as a sale of that asset. So they will record the lease receivables and sales revenue. Since they are recording as the sales of an asset, they will also record the cost of goods sold, and that's why the drone's cost is given here. And of course they are receiving the first payment, so release receivable or the first payment receipt will also be recorded. So now what we need to do just to calculate lease receivable amount. So lease receivable here will be the present value of all these future installments, or you can also call the present value of annuity, and its annuity due since it's at the beginning, and your N or year will be 5 and interest rate will be 8%. This is how we calculate the lease receivables and also lease payables, and there should not be any difference between these receivables and payables since there is no issue about residual value guaranteed unguaranteed part. So you can do two separate journal entry, one to record this lease receivable and this sale of that drone, and another to record the cost of goods sold, and then we will record the lease payments that they received. So first we have to calculate the lease receivable and we have to record it. So it will be on their balance sheet asset side, lease receivables, and they will record it as a sales. So lease receivables debit and sales revenue credit. So how we will calculate it? It's again simple. You have this installment or annual payment 40,800. Now you will find the present value of annuity table for 5 years and 8% interest rate. And if you look at that, you will find that the factor present value of annuity due factor is 4.31213. And if you multiply that, all the present value of those lease annual payments or installments will be 175,935, and they will record it also as a sales 175,935. So depending on how many decimal point digits you are taking after decimals, or whether you are using a financial calculator formula or Excel or a table, this amount may vary slightly by few cents, but don't worry. This is how you record the sale of that asset or drone. And you also have to record the cost of goods sold related to that asset or drone. So cost of goods sold will be debit, and then we have to eliminate that from our financial statement. So we will also eliminate that inventory or asset or drone, and the cost is given here 120,000. This is how the lessor will record the first journal entry. And then on the same day, December 31st, the lessor is receiving the first payment. So they will debit cash, and since they're receiving the first payment, they have to reduce the lease receivables by that amount based on the first payment, which is 40,800. 40,800. This is how you will do the lessor's accounting and journaling.